John Crypto here. Silver just hit $121.64 per ounce on January 29th, the highest print in modern history. Days later, nearly 50% of its value erased in what they're politely calling a liquidation event. Now it's hovering around 80 cents, $82, still 33% below the peak. And here's the part that should make you sit up straight. Bank of America just doubled down on a $309 silver target. Pause. How does an asset crash almost 50%? And one of the largest banks in America says it's going nearly 4x higher? That's not volatility. That's a setup. Here's the kicker. The media wants you to believe this was just speculative Chinese traders. That's the headline being floated. Treasury officials casually blaming speculative activity. Analysts calling it profit-taking after a 2-day rebound. Commentators shrugging and saying silver is just correcting. Funny how it works. When silver explodes higher to 121s, it's dangerous speculation. When it collapses 50%, perfectly normal volatility. And when banks quietly position themselves for 390s, silence, no front-page breakdown, no screaming panels, no investigation into who benefited from a historic wipeout. Now connect the dots. Silver didn't slowly bleed lower over months. It was liquidated. That word matters. Liquidations aren't gentle corrections. They're margin calls. They're forced selling. They're leveraged longs getting their accounts vaporized. Late January saw a wipeout that erased nearly half the price in weeks. That kind of move doesn't happen because jewelry demand slowed. It doesn't happen because one economic report missed by 0.1%. It happens when leverage snaps. Open interest in silver futures likely collapsed during that cascade. Retail traders who chased the breakout above $110. Gone. Long contracts forced closed. Stop losses triggered in waves. Algorithms dumping contracts by the thousands per second. If fundamentals were strong enough to push silver to $121.64, what changed in 10 days? Did global mine supply increase 50% overnight? Did industrial demand vanish? Did Mexico suddenly flood the market with surplus silver? No, only positioning changed. And that's where the crime scene starts to glow. Now here's where it gets uncomfortable. The crash was driven in the futures market. Paper silver, not trucks full of bullion being dumped into rivers, not vaults overflowing with metal. We're talking about contracts, leverage, digital claims on ounces that may or may not exist in physical form. The COMEX system has historically operated with leverage ratios that can approach 100.1, meaning for every real ounce sitting in registered vaults, there can be 100 paper claims trading hands. When price discovery is dominated by paper, it can be weaponized. And during that liquidation, massive volume poured through the futures market. Contracts dumped at speed. Price sliced in half. Retail longs wiped clean. But physical demand, industrial consumption, solar panel manufacturers, electronics producers, they didn't suddenly shut down operations because price hit 121. Here's the pattern you need to see. Paper silver collapses. Physical silver remains scarce. Price gets smashed. Narrative blames speculation. And in the background, institutions reposition. Retail walked straight into the trap. They bought the breakout at $110, $115, $120. They believed the momentum. They believed the inflation narrative. They believed the headlines. Then the rug got pulled. Smart money doesn't chase breakouts. Smart money engineers shakeouts. And here's the uncomfortable question. Why would Bank of America double down on a $310 price target after a historic crash? If silver were truly broken, if the rally was fake, if demand was collapsing, why not cut the target? Why not warn investors? Instead, they reaffirm upside because lower prices mean better entry zones, because forced liquidations create opportunity, because when weak hands are bleeding out, strong hands accumulate quietly. Now add this layer. Silver is still up 154% year over year. Gold is trading above $5,000 per ounce. U.S. retail sales just stalled. GDP control group fell 0.1%. Rate cut expectations are creeping back into the system. Non-yielding metals benefit when real yields soften. So while the public debates whether this was just volatility, the macro backdrop is quietly tilting bullish again. And if that's true, then the crash wasn't the end of the story. It was the reset. You think a 50% wipeout was random? You think a bank calling for $309 after a liquidation is coincidence? You think this was just speculators getting carried away? Wait until you see what's happening inside the COMEX vaults and why one of the largest silver producers on Earth, Fresnillo, just cut production by 10%, because that's where this stops looking like volatility and starts looking like a supply squeeze in disguise. Because that's where this stops looking like volatility and starts looking like inventory pressure. Let's go forensic. Pull up the COMEX data. Not the headlines, the vault numbers. You've got two categories, registered and eligible. Registered is the metal available for delivery against futures contracts. Eligible is metal sitting in vaults that isn't currently committed for delivery. Here's the tension. Futures open interest often represents multiples of the registered supply, paper claims stacked on top of real ounces. When silver ran to 121 per 64, open interest ballooned. When it collapsed toward $80, contracts were flushed. But here's the uncomfortable part. The liquidation didn't magically refill vaults. Silver is still up 154% year over year. That doesn't happen in a vacuum. That's structural demand. That's industrial pull. That's monetary hedging. Solar, EVs, electronics, all consume physical ounces, not paper promises. Now layer this in. Fresnillo, one of the largest primary silver producers on Earth, just cut production by 10%. Mexico is the world's largest silver producer. Not a small player, not a marginal mine. The top supplier. And during violent price swings, they're reducing output. Ask yourself, does tightening mine supply during volatility scream bear market? Or does it scream supply constraints ahead? Mine supply doesn't swing 50% in a month. Production pipelines are slow, capital intensive, and rigid. A 10% cut from a major producer isn't noise. It's future ounces that will not hit the market. And this is happening while futures traders are getting liquidated. That's not bearish, that's tightening. Now here's the trap most people miss. Futures contracts exist for hedging. Miners lock in prices. Industrial users lock in costs. That's the textbook explanation. But the scale of open interest compared to registered metal tells another story. There are moments when paper silver outstanding can represent claims on a volume that dwarfs deliverable supply. That's how you get violent price swings without a single truck leaving a vault. When liquidation hits, price collapses, even if physical bars never move. Let me ask you something simple. How can an asset lose nearly 50% in weeks when global mine supply didn't increase 50%, when industrial demand didn't vanish 50%, when central banks didn't dump reserves? Because price discovery happens in derivatives. Because algorithms trade contracts, not coins. Because leverage amplifies moves beyond fundamentals. That's the leverage trap. Retail traders chase momentum using margin. When price reverses, margin calls cascade. Contracts are dumped. Price gaps lower. Stops get triggered. More contracts hit the bid. It becomes mechanical. Physical demand, still there. Vault inventories, not exploding higher. Yet price collapses. Now watch the villains move. Bullion banks, often net short in futures during rallies, benefit when price drops fast. Stops get triggered. They cover shorts into panic. Then reposition, crash the price, trigger liquidation, cover exposure, flip long quietly, and suddenly Bank of America doubles down on $309 silver. You don't issue a four-stroke upside target in a collapsing asset unless you believe something structural is building. That target tells you institutions see a longer arc, and if they see $390, then $80 isn't a disaster. It's inventory. Lower prices mean better entry zones, better positioning before the next leg. Now think about the narrative they sold you. Speculative Chinese traders. Profit-taking. Volatility after a 2-day rebound. Clean. Simple. Convenient. But what if this wasn't chaos? What if it was a liquidity harvest? a shakeout engineered through leverage, a reset of positioning before the next macro wave. Because history whispers here. In 2008, silver crashed roughly 50% during the financial crisis. It looked dead, broken, finished, then it exploded nearly 400% in the following years. In 2020, silver dipped below $12 per ounce during the pandemic panic. Futures collapsed. Margin calls everywhere. Within months, it ran past $30. Violent shakeouts often precede violent rallies. And here we are again. Historic high at 121. Historic liquidation nearly halving price. Production cuts from major miners. Year-over-year gains still triple digits. Banks projecting triple-digit upside. That's not random. That's cyclical. But here's where it gets geopolitical. Because price discovery for silver doesn't only happen in New York, there's another arena, another exchange, another buyer base. If the West crashes paper price on the COMEX, what happens in Shanghai? When New York liquidates contracts, does Asia panic or do they import? Because while futures traders in the West were getting margin called into oblivion, the East may have been doing something very different. And if that's true, then this isn't just a trading story. It's a capital flow story. Because while New York was liquidating, the East may have been buying. Because while New York was liquidating, Shanghai was quietly humming. Here's the kicker. The Shanghai silver premium has been trading above the COMEX price. That's not a minor footnote. When Shanghai trades higher than New York, it signals physical tightness. Arbitrage flows metal eastward. Paper price manipulation in the West doesn't stop real ounces from moving. It just allows the East to buy cheaper in New York, ship physical metal to China, and hoard actual delivery. So while futures contracts in the US were bleeding out, Asia was quietly absorbing physical silver, tightening the real-world supply chain. This isn't theory, it's structural. When COMEX suppresses price with paper leverage, physical silver doesn't disappear. It vanishes from vaults and lands in Asia. Now connect the dots to the secret buyers. Who's scooping this up? The obvious suspects: sovereign accumulation, state-backed entities, and industrial giants front-running future shortages. Don't think small-scale traders, think China, India, and possibly unknown sovereign wealth funds. They're buying for energy infrastructure, electronics, and solar panel expansion. Industrial demand is relentless. Electronics components, photovoltaic panels, and EV batteries all need silver with predictable supply. This is why silver isn't just a precious metal. It's strategic industrial currency. Forget paper ETFs. The real battle is for physical metal, and the East is winning quietly. Here's where it collides with policy. US retail sales stalled, and the GDP control group fell 0.1%, confirming a slowing economy. Expectations for rate cuts are rising. That's a subtle but seismic shift. Lower rates mean non-yielding assets like silver and gold become relatively more attractive. Weakening dollar, rising inflation expectations, and rising geopolitical tensions make hard assets suddenly strategically desirable. Think about it. The Fed could pivot to easier policy, sending capital rotations toward hard assets, while paper traders scramble to cover. The West may think it's manipulating price, but the East is buying the real thing. This is capital arbitrage on a global scale. Now the supply chain war intensifies. The big three producers, Mexico, Peru, China, are already under pressure. Fresnillo's 10% production cut isn't just a blip, it's a leading indicator for future supply shortages. Mining grades are declining globally, capital expenditures are constrained, and ESG regulations are increasingly restrictive. Every ounce withheld today becomes scarce metal tomorrow. Combine this with the industrial pull. The pipelines for solar, electronics, and EV components are demanding more silver, not less. That's the perfect storm: shrinking supply, rising industrial demand, and relentless accumulation by state-backed buyers. And then there's the dollar replacement angle. US debt is exploding past $38 trillion. Global confidence in the greenback is under pressure, and emerging markets are reducing dollar exposure. Silver and gold are quietly becoming the hedge against fiat debasement. If the dollar cracks, hard assets like silver will reprice violently. and physical shortages will amplify the move. Now zoom out. While COMEX price manipulations make headlines, the bigger picture is global financial realignment. Physical silver is migrating east, production cuts tighten supply, industrial demand escalates, and Western paper prices are increasingly irrelevant. This is where silver stops being about traders, stop being about speculators chasing momentum, stop being about headlines blaming Chinese traders or profit-taking. No, this is now about monetary survival, about who holds real assets when fiat confidence falters, about which nations, corporations, and institutions will control tangible silver in a world of leveraged paper claims. And that's the bridge into part 4, because once you see the macro doom, debt traps, and Fed's printing game, it's no longer a market story. It's a systemic crisis waiting to erupt. What happens when paper crashes but physical is hoarded in the East? When the Fed prints debt balloons and Western investors are still stuck with leveraged futures? And when you start connecting the dots, you realize this isn't just a market hiccup. It's a systemic unraveling. Let's start with the bond and debt crisis. The US debt is now flirting with $38 trillion, with interest payments eating deeper into fiscal capacity every month. Japan's bond market is teetering with negative yields and fragile confidence, while global sovereign debt sits at record highs. The math is brutal. If rates fall, inflation risk rockets, eroding purchasing power. If rates rise, the debt spiral accelerates, threatening defaults, no-win scenario. And this is why metals are not optional. They're strategic insurance. Now look at the Fed. Retail sales have stalled, GDP control group is down 0.1%, and market pricing is screaming for easier policy. But the Fed's options are poisoned. Cut rates and inflation returns like a beast. Don't cut, and recession hits like a freight train. Either way, non-yielding assets like silver benefit. This is the printing trap. Every path the Fed takes fuels hard assets. Here's the trap nobody talks about. The system is broken. That 50% silver crash in late January wasn't normal. It exposed the fragility of leveraged positions and the dominance of derivatives over reality. Yet physical supply is tightening. Fresnillo slashed 10% production, industrial demand remains intact, and monetary demand is quietly rising. The disconnect between paper and reality cannot last. Volatility on paper, scarcity in vaults, this is the breaking point. Now, for the price logic. If silver simply returns to the $121 high, that's a 150% move from current levels near $80. But breakout above 121s, that's price discovery in action, driven by tight physical, east versus west flows, and institutional accumulation. And then there's Bank of America's target, $309 per ounce, 3 to 4 times the current price. At first glance, that sounds insane. But when you see $80 as artificially suppressed by paper liquidation and derivative manipulation, suddenly $309 doesn't seem crazy. It seems inevitable. So what do? First, get physical exposure. Understand the difference between registered versus eligible. That's the real metal you can touch versus paper claims. Don't rely on futures, ETFs, or promises that vanish with margin calls. If you want to survive the next leg, self-custody of bullion is the strategy. Because when the system shakes, paper slips through your fingers, but physical stays tangible. And here's the mic drop. When paper silver collapses 50% in days, it's volatility. When physical silver disappears from vaults, it's a warning. And when banks quietly raise targets during chaos, it's not a prediction. It's preparation. The stage is set. The West controls the paper, the East hoards the metal, production is tightening, and the global financial system is limping on leverage. Every forced liquidation, every Fed pivot, every whispered target is part of a larger chessboard. And make no mistake, this isn't about timing a trade. It's about seeing the system for what it is, understanding who really controls the physical metal, and positioning accordingly before the next shock hits. Because the next move won't be subtle. The next leg in silver and in hard assets broadly will obliterate complacency. Paper silver is fragile. Physical silver is strategic. And if you haven't already asked yourself where your exposure lies, The system's next collapse will answer for you. The system is rigged, the banks are hiding in plain sight, and paper silver can vanish in a heartbeat. But physical metal doesn't lie. It's scarcity, it's insurance, it's power you actually hold. The chaos isn't random, it's a setup for those who see it coming. Don't wait for the next wipeout to hit. Check your exposure. Move metal off exchanges. Understand registered versus eligible silver. Self-custody your bullion, because when the system bends, only the prepared will survive.